This comes as a surprise, given India's strong fundamentals and improving earnings outlook. However, it seems that investors are cautious about the market due to concerns over AI exposure, weak growth, lack of reforms, and high valuations. According to the survey, 32% of respondents were net underweight on Indian equities, making it the least preferred market in Asia. This is a significant shift from previous surveys, where India was considered one of the most promising emerging markets. In contrast, sentiment has improved for Indonesia, with 27% of fund managers saying they were net underweight on the market. It's worth noting that global funds have still been buying Indian stocks, with over $4 billion in purchases this quarter. However, this hasn't been enough to boost investor confidence, and the NSE Nifty 50 index remains one of the worst-performing major markets in Asia this year. We'll be exploring this story further and examining what it means for investors. We'll also be looking at other news from the world of finance, including the latest developments in the tech sector and the impact of global events on stock prices. In another story, CLSA has downgraded Indian 1T stocks, citing concerns over AI disruption and valuation multiples. This comes as a blow to the sector, which has been one of the strongest performers in recent years. We'll be analyzing what this means for investors and whether it's time to reassess their portfolios. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of artificial intelligence and the significant investments being made by tech giant Nvidia. The company has recently announced a $1.5 billion investment in an 8-gigawatt AI campus in Ohio, which will be used to support OpenAI's operations. This massive project highlights the rapidly growing demand for AI computing capacity and the need for dedicated electricity generation and transmission infrastructure. Nvidia's move is not only a strategic play to secure its position in the AI market, but also a testament to its strong financials. With quarterly free cash flow increasing 18 times over the past 3 years to $48.5 billion, the company is leveraging its balance sheet and credit rating to build an AI capital moat. This investment will not only provide Nvidia with a competitive edge, but also create tens of thousands of jobs in Ohio and stimulate local economic development. It's worth noting that this project has sparked concerns about the environmental impact of large-scale AI computing facilities. The development is expected to require at least 10 gigawatts of new power generation, which could potentially strain regional energy resources. However, the companies involved are working to ensure that the costs of serving the data center campus are not shifted onto existing electricity customers. As we continue to navigate the complexities of the AI landscape, it's essential to consider both the opportunities and challenges presented by these emerging technologies. Nvidia's investment in the Ohio AI campus is a significant development that will undoubtedly shape the future of the industry. Welcome back to the closing segment of the Riskwiser Zone. As we wrap up today's discussion on market trends and investment opportunities, I'd like to shift our focus to a stock that's been making waves in the S&P 500 index, SanDisk, or SNDK. This company has been leading the charge with its impressive performance, jumping 8.9% to $1,786.85 on Monday, moving above its 50-day moving average. Now, what's driving this bullish move? Well, it seems that a new buy recommendation from JP Morgan has given SanDisk a significant boost. The investment firm raised its price target for the stock to $2,250 while maintaining an overweight rating. Citing the company's position as one of the top global NAND flash memory suppliers in a market experiencing demand expansion from the artificial intelligence sector. But that's not all. SanDisk's new business model framework, which covers 8 key customers with committed volumes and minimum financial guarantees, is expected to account for approximately 50% of bits in fiscal 2027 and roughly two-thirds of bits in fiscal 2028. And if that's not enough, the company's technology roadmap includes unveiling the BiCS9 and BiCS10 QLC nodes, with the latter delivering a 60% higher bit density compared to BiCS9. As we delve deeper into the numbers, SanDisk has issued a mid to high teens revenue growth guidance for fiscal years 2028 to 2030, with non-GAAP gross margins projected at approximately 80% and non-GAAP operating margins expected at 75%. The company's CFO, Louis Riskwiser, noted that they're optimizing for growth, sustainability, and returns, and expect to return 100% of excess cash to shareholders after investing in the business. Now, I know some of you might be thinking, what about hedge fund participation? Well, it seems that institutional investors are taking notice of SanDisk's potential. The latest filings showed that Leopold Aschenbrenner-led hedge fund Situational Awareness held $5.7 billion worth of shares in SanDisk as of end June, before disposing of a large chunk of its portfolio in AI stocks in July. And more notably, 114 hedge funds held positions in the company as of the first quarter of the year, up markedly from 75 previously, with their combined holdings soaring by 105% to $11.3 billion. As we conclude today's discussion on SanDisk, it's essential to remember that while the company's prospects look promising, it's crucial to approach any investment decision with caution. As I always say, investing is a marathon, not a sprint. It's essential to do your own research, consider multiple perspectives, and never put all your eggs in one basket. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.